Welcome to this ACCR webinar ahead of BP's AGM, which is just over 3 weeks away now on the 23rd of April. My name is Sarah Bruin. I'm ACCR's Stewardship Impact Lead, and I'll be hosting today's webinar. The focus of today's discussion will primarily be around the shareholder proposal that ACCR has filed at BP for this year's proxy season, together with a number of institutional investor co-filers, including Nest, Greater Manchester Pension Fund, Merseyside Pension Fund, London CIV and Publica. And that's a shareholder proposal calling on the company to disclose how it takes a disciplined approach to capital allocation in the upstream. And we'll also be touching today on the company's response to that resolution in its notice of meeting, which came out a few weeks ago now, as well as some of the broader governance and shareholder rights concerns that have been enlivened by the company's notice of meeting. So joining us today for this discussion, we have Nick Mazan, who is ACCR's Oil and Gas Strategy Lead. He's been with ACCR just over 2 years and joined from the finance sector, having spent the last 10 or so years in oil and gas stewardship, previously at Robeco and prior to that at Federated Hermes. And we also have Katharina Lindmeier, who's joining us from Nest. She's Nest Head of Sustainability Strategy, and she'll be stepping in for Maeve O'Connor, who's unfortunately unwell today. Nest, as I mentioned, is one of the co-filers of the resolution. They're a DC pension scheme with 50 billion AUM, about 14 million members across the UK. So we have a presentation that we'll be running through, which presents the resolution, the rationale for having filed the resolution, and the research that ACCR has conducted that underpins that resolution. But before we sort of fire up that presentation and run through those slides, I wanted to turn to first Nick and then to Katharina to give us a little bit of the context around this resolution and why we filed it. So let me turn to you first, Nick, to give us a bit of the why. So why this resolution, why this company, and why now? And then Katharina, I'll turn to you to speak a bit about Nest's motivation for co-filing in particular.
Yeah, thank you, Sarah. So yeah, as Sarah mentioned, our focus around capital discipline at BP. There's going to be 4 components to this presentation. The first focuses on why capital discipline, and we look at BP's performance over the past sort of 3, 5, 10, 15 years, and show that BP sort of chronically underperformed its peers and the industry as well. And the oil and gas industry itself has been the worst performing sector over the past 15 years as well. And we look at that across a range of different metrics as well. And I suppose one of the things that exists currently in terms of the narrative around BP is that it's as a result of its overinvestment in clean energy, and that sort of the strategic reset in 2020 that was brought forward by Bernard Looney and Helge Lund was the reason for this financial underperformance. But we look further back than that and look at the financial underperformance over a longer period of time and shine a light on the chronic issues related to BP's investment in the upstream. Then we look at sort of the strategic changes. And I suppose for us, it's the combination of the financial underperformance and the announcements that were made at the Capital Markets Day in February 2025 that really underpin the rationale for the resolution at BP this year. So BP announced that they'd be increasing their upstream capex from 8.5 billion to 10 billion, and also increasing their exploration capex as well, and not defining by how much that'll be. After looking more broadly at sort of the conditions for the resolution and sort of why we focus on capital discipline and why now, we'll go into the 3 components of the resolution. First of those is looking at the relative cost competitiveness of pre-FID projects for oil and gas, where BP's projects sit on the cost curve, and the disclosures, particularly around that or lack thereof for BP. The second component is around project execution, and we look at cost overruns and project delays and the degree to which that can have an impact on the potential NPV of pre-FID projects, and how BP could be overestimating the value of its projects by not including these assumptions. Final component is around exploration. This is really as sort of probably the newest bit as it relates to the discussion around capital discipline. We haven't seen too much of this in terms of the dialogue between investors and the companies or within the sector more broadly as it relates to the discussion around capital discipline. But we do think this is a material outlay for BP, which has been spending around 2 billion on exploration over the past 14 years. And what we see across the sector is a decline in the return on investment related to exploration capex. Right now, we're seeing sort of increased sentiment towards exploration capex, and there's this increased bullishness. And we saw this reflected in the earnings calls last month, where companies are cutting back on shareholder distributions and favoring production growth and the growth in exploration capex as well. So we think they're sort of bringing attention to this issue for BP, which has performed worse than its peers, is timely as it relates to sort of the winds of change within the oil and gas sector. That's a little bit of an overview of what you're going to hear today, and we'll be going into all of that in a little bit more detail. So I'll pass over now to Katerina to speak about Nest's perspective on the resolution.
Thank you very much, Nick, and thank you for having us on today. So as Sarah said at the start, Nest is one of the largest pension schemes in the UK. We have around 14 million members. That's around 1 in 3 of the UK workforce. So the success of UK PLC is really important to us, and BP is a household name, and it's one of the companies in our portfolio that members are going to recognise, and we receive questions from members on a regular basis. So BP has been an engagement priority for us for multiple years. As I'm sure many of you were, we were supportive of the strategy announced around 2019, 2020, and we stepped up our engagement when the first sort of initial strategic pivot away from that strategy happened in 2023. We've been engaging with the company since then, including some positive meetings we had with the former chair, Helga Lund, around the longer term strategy. We had lots of reassurances around there not being a significant pivot in the strategy and the overall net zero ambition until we saw that bigger reset last year. And our perspective on the resolution is really that we've seen a lot of changes and mini pivots, more substantial pivots over the last few years, combined with poor financial performance. And while I think we recognize that the transition strategy did not work out as well as I think both BP and we as investors would have hoped, we also have concerns that this strategic pivot may not add financial value. And therefore, we think it's really important that investors have all the right information from the company to help them identify and challenge the company on its capex decisions. So that's really the basis for why we've decided to co-file. We think escalating at this point to a shareholder resolution is an appropriate step. We think there's a good opportunity with a new management team coming in for investors to really set out what the expectations are for the company and hopefully have a good dialogue on these disclosures, some of which we already see other companies in the sector making. Others, which as Nick said, are probably a little bit more difficult for companies to make at this point in time, but BP has in the past been a leader on some of these areas, and we think they can be a leader again. And again, as a significant UK company, we would like to see them be a leader in this space. So I'll maybe just leave it there, and we can go into the presentation, and then happy to answer any questions on the investor perspective later on in the Q&A as well. Thank you.
Thank you so much, Katerina, and thanks to you both for those opening remarks to set the scene for the presentation that we'll now give. And as Katerina mentioned, we will have a substantial time for Q&A at the end of the session, so please do feel free to put your questions in the chat at any point or hold them until the end, and we'll make sure that we do manage to get to them. So with that, let me hand back to you, Nick, to run through the first part of the presentation.
I touched on this at the beginning. We look here at total shareholder return for the oil and gas sector relative to the MSCI World Index. on the left-hand side there, you can see how the MSCI World Energy is the worst performing sector over the past decade. That's sort of predominantly oil and gas, about 99% oil and gas and about 70% exploration and production companies that sit within that. So that's on the left-hand side. On the right-hand side, you see the comparison of BP on a 3, 5, 10, and 15-year basis relative to that index, and then relative to its significant peers in terms of the European super majors. And you can see it sort of the underperformance across all of those time frames for BP relative to its peer group and relative to the sector as well. And so as it relates to sort of this concern that investors have in terms of the overinvestment in renewables, we sort of take this a little bit further back, because really we saw the uptick in capex into the transition growth engine businesses for BP only come about in sort of 2020 after the new strategy from Bernard Looney. And even then, sort of, it was not a material outlay for BP. It was always sort of around or below 10% of capex for BP. But really looking over these longer timeframes, we see that there's bigger issues for BP from a sort of investment framework perspective, which is what we're trying to investigate, I suppose, through this resolution. So we look at this across a range of other financial metrics as well. So return on equity, return on assets, and return on capital. And you can see across all of these other financial metrics how BP has performed and underperformed relative to the sector as well. And really, this is to show that sort of whilst we think total shareholder return is the most central factor for investors, across these other return metrics as well, BP has been underperforming, and sort of again over these multiple timeframes raises concern around sort of the capital allocation strategy for BP. We look at BP's impairments and disposal losses over the past 5 years. Again, this sort of speaks to the prevailing narrative around BP having overinvested in the low carbon business. And you can see, whilst there was a large announcement at the Q4 earnings call in February 2026, a 5 billion write-down on the low carbon business, that when you take this in the context of the last 5 years, where the company has been making more material investments in its transition growth engines, you can see that the relative amount of disposal losses and impairments is proportionally equal to the amount of capex that's gone into that business. So that's around 10% of capex, around 10% of disposal losses and impairments. So whilst that 5 billion is not immaterial and obviously meaningful for investors, the majority of the disposal losses and impairments have been within the oil and gas segment of the business. I'd say sort of one thing that probably comes up with our conversations with investors is that what we're not trying to do here is defend those investments in clean energy businesses. We do think BP probably has misallocated capital in that regard. But what we're trying to do with this resolution is widen the aperture of how BP is interpreting its capital discipline rhetoric from just focusing on the transition growth engine business, where we have seen a really substantial reduction in capex, and thinking about that in the broader context of the whole capital allocation budget for BP. One of BP's responses to our resolution in the notice of meeting is that it's exercising capital discipline through reducing its overall capital allocation budget from around $15 billion per year to around $13 billion per year. Most of those cuts have been happening in the transition growth engine business. And what we've seen, as I mentioned, is that there's been this pivot to increasing upstream capex from 8.5 billion to 10 billion, and that sort of being a real concern for us. We can see specifically how BP's capital allocation into the upstream business has been over the past 5 years. So BP spent around 22 billion in greenfield capex into its upstream business over the past 5 years. We've calculated the net present value of those assets under forward prices, and we calculate that the value of those assets is less than 1 billion, 0.9 billion over those past few years. And so really sort of this raises the question for us and for investors, we think, as to whether BP is really investing in assets that are going to be profitable for shareholders. And we get into this into some of the specifics around the resolution as it relates to BP investing in projects that sit high up the cost curve and which aren't as profitable relative to its peers and relative to the industry as well.
Thanks, Bo. I'll just actually get the next slide up. We were going to, just sort of paint, I guess, a bit of a picture of the last 6 or 7 years at the company, and where this resolution and where the sort of latest responses from the company in its notice of meeting kind of fit in against the backdrop of this timeline. So if you take this back to 2019, it's sort of unthinkable to think of now in 2026, but at that time, CA100 Plus filed a shareholder proposal at the company, which was co-developed with management, supported by management, and received 99% of the shareholder vote. And that was a resolution calling on the company to disclose each year a strategy that it considers to be consistent with the goals of the Paris Agreement. And this is one of the 2 climate disclosure related resolutions that the company is now seeking to rescind. So this resolution in 2019 was sort of paired with the transition strategy led by Bernard Looney for the company to transition from being an international oil company to an integrated energy company, and along with that, its sort of flagship target to cut oil and gas production by 40% by 2030. That transition plan was put to a vote in 2022 and supported by a majority of shareholders. And then only 9 months later, in 2023, we saw the company cutting that oil and gas target from 40% down to 25%. And then last year at the Capital Markets Day, or just ahead of the Capital Markets Day, cutting that target completely and announcing this new fundamental strategic reset. And so this is a sort of what you can see here in the yellow box, this set of announcements at the Capital Market Day that the company would be slashing investment into its low carbon business and increasing upstream capex from 8.5 to 10 billion. As well as Nick has mentioned, reloading the exploration hopper, so increasing the exploration spend without providing forward guidance on what the quantum of that will be. So after we saw that announcement, there was a really significant historic protest vote against the then outgoing chair, Helge Lund, who was replaced in July by Albert Manifold. To sort of close out 2025 at BP, we saw another major leadership change with the CEO being replaced by Meg O'Neill, who will be joining the company tomorrow. The company released its notice of meeting a few weeks back, and there were a lot of elements in there that are perhaps sort of surprising to see, especially in light of this kind of last 5 or 6 years of major strategic and leadership changes. So we saw a number of proposals from the company to make changes to the Articles of Association to allow for virtual only AGMs, citing the need for sort of accessibility and modernisation, which is, I suppose, a curious motivation in light of the fact that they already are able to run hybrid AGMs and have done so successfully for a number of years. That's Resolution 22. Resolution 23 is seeking to rescind, as I mentioned, the CA100 Plus shareholder proposal from 2019 and the previous climate disclosure related resolution. The company citing a mandate to reduce overall the reporting and disclosure burden that it has, and is also claiming that both of these resolutions have now been superseded by legislation in the UK requiring mandatory climate disclosure. And we have some analysis that we can share with anyone who's interested by Share Action that just does a bit of a gap analysis between that legislation and these 2 resolutions, suggesting that this sort of claim of being superseded by law is perhaps not well founded from BP. The company has also recommended against support for the ACCR filed resolution, and we've published a response to the company's response, and I'll just sort of draw out a couple of elements of what the company said in response to the resolution. And some of these we'll sort of touch on later in the presentation, and some we've already touched on, but a few points of interest. So one is that the company said that the resolution is overly narrow in scope because it's sort of too focused on shareholder returns. Our position is that it's eminently reasonable for a shareholder proposal to have a focus and to to have this focus on shareholder returns. We think it's reasonable for shareholders to expect a company to deliver acceptable returns, and particularly in light of BP's prolonged underperformance that has been well documented and that Nick has touched on earlier in this presentation. Nick's already mentioned this, but the company's pointed to its reduction in overall capex as an evidence of its commitment to capital discipline, and one of the reasons why it thinks this resolution isn't relevant. But as Nick said, that reduction in overall capex is not targeted towards upstream capex, so that reducing overall capex but growing capex into the upstream, and that is where this resolution is focusing on. The company also says that the resolution is duplicative and that it already discloses approach to capital discipline, and it points to a number of places in its annual reports that it thinks sort of satisfies what this resolution is asking for. Our written response provides a kind of detailed side-by-side to show that we actually don't think that the company is reasonably has sort of satisfied these asks of the resolution. One of the things they point to, interestingly, is its strategic alignment criteria and the requirement for its projects, or the consideration that it gives to new projects as to whether they are aligned with the company's overall strategic focus, including its commitments to the goals of the Paris Agreement. And what's interesting about this is that this particular strategic alignment criteria comes from the 2019 CA100 Plus resolution, which the company's elsewhere in the notice of meeting trying to rescind. So it's quite a sort of curious circular logic to say this ACCR filed resolution isn't necessary because we have this strategic alignment criteria, but also we're trying to remove the resolution which requires us to consider this strategic alignment criteria at the same time. So that's sort of, in a nutshell, its response to the resolution. There's also a reduction in the size of the board from 13 to 10. This is again part of the sort of overall streamlining mandate that we're hearing the company as responding to. And what's sort of interesting or notable about that board reduction is that there's one non-executive director stepping down, Simon Henry, who is a former CFO of Shell, who's only been on the board for 9 months. So that's quite a curious change to the board that hasn't really been well explained by the company. And then finally, and this is kind of one of the bigger issues that isn't on the notice of meeting, but that I'm sure a number of you are aware of, that the company has excluded a shareholder proposal filed by Follow This and a number of institutional investors. The company has not explained its rationale for excluding the resolution, which I think is kind of one of the bigger elements of concern here. So they had previously confirmed to Follow This that the resolution had been validly filed and met all of the relevant thresholds for a valid shareholder proposal in terms of paid up capital and number of co-filers. And then when the notice of meeting came out, that resolution wasn't present on the ballot. And so this is causing a lot of concern around the company's approach to shareholder rights. It's not an action that has really any kind of precedent or analogue in the UK, where the grounds for not including a shareholder proposal are very limited. And we've heard concerns and question marks from investors that this appears to be a sort of posturing to a sort of US style no action process, which is not something that's provided for in the UK legal system. But that allowing this to go sort of unchecked could lead to this becoming a bit of a precedent. So I'm sorry I dwelled on that slide for quite a long time, but there was obviously a lot to unpack there in terms of the sort of past history of leadership and strategy changes at the company, and then this most recent approach to shareholder rights, which I think, again, is curious in light of this sort of chaos over the last 6 or 7 years, and perhaps a sort of interesting move from a company that you might think would be more inclined to sort of steady the ship at this point in time. So with that as context, I think we're ready now to get into the meat of the resolution. I'll skip ahead in the interest of time to the slide that has the resolution text on it. This is all part of a longer presentation that we do when we have a full, we are skipping over a little bit of content in the interest of time, but all of these slides will be available after the webinar recording is published. So this is the text of the resolution that has been filed. I won't read it verbatim, but you can see that it is a disclosure-based resolution. So it's calling on the company to disclose how it promotes a disciplined approach to capital expenditure in the upstream, so focusing on new material oil and gas projects, and seeking the company to explain how it integrates relative cost competitiveness, cost overruns and delays, and continued exploration capex into its investment decision-making to ensure reasonable returns for shareholders. So this is the resolution, and what we'll do with this next part of the presentation is talk through each of the resolution asks in turn, explain why it's material, and explain the research that we've conducted under each of these categories that gives us particular cause for concern at BP and why we chose to include these as a focus for the resolution. So this is the first resolution ask, and it focuses on cost competitiveness. So we're asking the company to disclose how it considers cost competitiveness of new material oil and gas projects. And the reason for that is simply that we're a company sanctioning projects that sit too high on the cost curve, risks approving projects that won't be resilient to a lower price environment in future, and that has a risk of eroding value for shareholders. And the reason that we've chosen to include this component in the resolution is that based on ACCR's own research, which is an analysis of Rystad data, shows that both BP's oil and gas portfolios are not particularly competitively advantaged, and its gas portfolio in particular is of concern, sitting on average at more expensive than 73% of global pre-FID supply. So this is probably the most anodyne and straightforward in many ways of the three resolution asks. We do see analogues of this type of disclosure when we look at close peers of BP. So both Shell and Total produce cost curves for their respective portfolios. Total produces a cost curve analysis of its LNG projects and its oil projects. So we do think this is something that is well within scope for BP to do. And just over on the next slide is just sort of another example of a particular FID from the company that I think sort of serves to underscore why it's relevant to understand how BP thinks about cost competitiveness and how it can be sanctioning, for instance, projects like this one, which was sanctioned last year, which sits at more expensive than 81% of competing pre-FID oil supply. It really begs the question for shareholders how the company can be making these types of FIDs while at the same time claiming to be investing with capital discipline. So this is resolution ask number one. Over on the next slide, I'll take you through the second resolution ask, which pertains to project execution. So how the company integrates assumptions around its ability to deliver projects on time and within budget into its investment decision-making processes. And the reason that we've chosen to focus on this particular element of capital discipline for BP is really starting at the sort of sector level research. And that's what you see here on the screen. We have examples from a number of different sources that suggest that there is a problem with project execution within the oil and gas sector as a whole. So what we can see here is that there is a wide range of research that's showing anything from 17% up to 59% of projects being delivered late. And with significant budget slippage as well across the board. So looking at this research at the sector level sort of piqued our curiosity to understand what impact this project execution, these sort of slippage rates have on a company's portfolio and how they value pre-FID projects. And that's what you're seeing on the right-hand side of the screen. This bar chart is a sensitivity analysis that we've run on BP's pre-FID portfolio. And we fed two assumptions into that portfolio and assumed that those projects would be delivered 1 year late and 20% over budget. And these are fairly moderate project execution assumptions based on what you can see at the sort of sector level. And even these fairly moderate assumptions have a really significant impact on the value of BP's pre-FID portfolio. So a 66% reduction in the apparent value of those projects. The concern here is that if BP is using over-optimistic project execution assumptions, it might be sanctioning, overvaluing projects and therefore sanctioning projects that could be value erosive. So this is taking a bit of a closer look at BP's project execution track record in particular and trying to reconcile some of their recent claims about project execution, particularly in response to this resolution. And what we can say is that based on the limited disclosure that BP is making, it doesn't appear that they do a particularly better job than the rest of the sector, that they provide fairly limited disclosures as to budgets and as to target startup dates, which makes it particularly difficult to reconcile some of the claims that it's making about having recently improved project execution. So what we've done here is look back at the last 10 years of BP's annual reports and found that for those projects where they reached FID and started up before the end of 2025, and where they did disclose a target startup date, 61% of those, as a proportion of greenfield capex, started up late. We had a look back at the claims that BP's made in response to the resolution that it started up 7 major projects 5 ahead of time in 2025. And what we've seen is that based on what they've disclosed in terms of target startup dates, 2 of those started late, 1 started up on time, and for 4, we couldn't identify a target startup date disclosed by the company. So it's hard to verify or to reconcile when they say we've started up on time, where they didn't previously disclose what on time would be for those projects. So this is why we filed, why we've included this particular ask in the resolution, to try and understand both what BP's recent track record has actually been, and then to understand, based on that track record, what assumptions they're deriving and whether those assumptions are appropriate in light of what we know about their ability to deliver on time and within budget, and whether those assumptions are making appropriate valuations of pre-FID projects. Let me hand over to Nick to take us through the last resolution ask on exploration.
Great, thanks, Sarah. So I mentioned at the top that sort of this is probably the newest part as it relates to the discussion around capital discipline, but one which we think is really important right now as there's this more increasingly bullish sentiment around organic growth and the need for exploration capex. I think it was quite notable at the earnings call last month that sort of the criticism Shell received around its decreasing reserve life and what we see from a valuation perspective right now in terms of companies with longer reserve lives getting a valuation premium. And there seems to be this reorientation from value over volume to volume over value, seemingly. When we look at exploration success rates and the return on investment related to exploration, we see sort of a massive fall off from the 1990s onwards, essentially. And what we see here across the industry is that for every dollar that's been invested in exploration since the 2000s, it's destroyed 71 cents of value. And so this sort of really raises the question as it relates to BP's continued significant investments into exploration as to whether this is going to be a good return on investment for shareholders going forward. I think the other sort of element of this conversation around exploration is sort of the lead times associated with exploration. In the IEA decline rates report, which came out last year, they stated that the average turnaround time from investing exploration capex to producing your first oil and gas was around 11 years. So that $2 billion that BP is spending, and I suppose trading up the option for returning cash to shareholders in the short term for favoring exploration growth, we're only going to see sort of the fruits of that in 2037 on average onwards. And so I guess this sort of brings into light the longer term nature and the uncertainty that we're facing as it relates to the longer term demand profile related to oil and gas as well. On the next slide, we go into a little bit more detail around why this is happening and sort of what does this look like for BP specifically. So the first graph was about return on investment across the sector and how that's been declining over time. This one looks at sort of the more technical aspects of that. So what we see here on the left-hand side is a decline in exploration success rates. So going from around 70% in the 1990s to around 20% in the 2010 to 2024 period. Commensurate with that, and obviously related to that, is an increasing cost over that time frame from around $2 per BOE discovered to around $6 per BOE discovered. So what we see here, sort of from a geotechnical perspective, there's becoming harder and harder to find good acreage for oil and gas companies, but for BP specifically as well. We've seen some publications by Wood Mackenzie too that's comparing the largest oil and gas companies, Eni, Exxon, Chevron, etc., and looking at the internal rate of return associated with exploration capex. Eni obviously has a very good track record as it relates to exploration and has carved out a little bit of a brand recognition around that. And BP came out the worst in that assessment as well. So there's clearly sort of a very strong rationale, both in terms of the quantum of capex that's going into exploration, but also associated with BP's performance on the exploration side of things as well. So this slide, we look at sort of the degree to which BP's exploration is contributing to its current supply. And whilst we've seen an increase in exploration capex from the early 2000s to the 2010 period, a 2.5 times increase, we're seeing very little of that feed through into BP's current production. And if you chart this forward, this is based on Rystad data over the next 25 years as well. We see a very similar picture in that much of BP's projected future production and historic production is coming from assets that are found before the 1990s or even before the 1970s. And so whilst the company's spending more money, its contribution to cash flow from operations is limited. One thing that I think is really interesting as it relates to the current macroeconomic environment is we see a really strong correlation between oil prices and exploration capex across the sector. And so we see this sort of cyclical nature to exploration capex, where as we see, I guess, the windfall that we're expecting to see in the sector, we see this sort of unleashing of capital expenditure into exploration. And I suppose this was in some ways okay, in some ways it destroyed a lot of value for shareholders in the sort of 2014 to 2019 period. But now we face a much different environment in terms of sort of what the future demand prospects looks like for oil and gas and how many cycles we're expected to face in the future. And so I suppose what is the concern here is that as oil prices have increased, that this is going to sort of again incentivize further investment in exploration when really the demand for those assets might not be there and the returns on those assets might not be there for shareholders. So bringing this part of the discussion into sort of the engagement with BP, we think was really important. And finally, just on Boomeranghi, which I suppose is something that we've been hearing a lot, both in terms of our conversations with investors, but from BP specifically. So Boomeranghi is the discovery that was made last year by BP in Brazil. They're saying it's the biggest discovery that they've made in the past 25 years, and that it could be around $8 billion barrels of oil. So if that were to be the case, that'd be sort of incredibly substantial. I would say sort of as it relates to Boomeranghi, it's very early days. We're not expecting the appraisal due until Q1 2027. And so the information that we do have around this project is pretty limited at this stage, and we'll only get more information in sort of 9 months' time or so. And so there's sort of very different valuations that we've seen by analysts in the city, but also by Rystad. And that's sort of really varied at the moment. We know that there's a sort of high CO2 content, but again, how that'll feed through into operational costs is a little bit unknown at the moment. So there are really big question marks around this, but what we're looking for in this resolution from BP's disclosures perspective, more of a systematic analysis. So it's not about answering the resolution with, okay, here's a really good project, but really, how is this allocation of around $2 billion per year providing value for shareholders as a whole? So stepping away from the singular project level data to sort of looking at that capital allocation in a more holistic sense. Yeah, I think that that's where the sort of bigger question comes in as to whether this is going to provide value for shareholders going forwards as well, and sort of bring that inquisition, I suppose, into this performance.
Thanks very much, Nick. So we do have a sort of final summary slide on here, and I won't speak to this in detail now. I'd like to leave sufficient time for Q&A, but I'll just put this up as a bit of a snapshot of the 3 resolution asks, why they matter, what the kind of current state of BP disclosures are, and some of the outstanding questions that we think aren't currently able to be answered based on those disclosures. One of the questions that we get a lot is around peer examples of disclosure that meet the resolution asks, or that sort of fit under these 3 categories. And in the materials in this presentation that you'll get, along with the recording at the back of the presentation, there is a slide that gives just 1 or 2 peer examples under each of these 3 categories. So I'll just sort of leave that as a note for further reading. But I wanted to turn to a question that we've got through the chat, and I think it's an important one as a sort of opener. I also have a couple of questions for you both, Nick and Katerina, and if you have questions as a participant, please pop them through the chat. But this first one that's come through is a question about the sort of motive, I guess, of the resolution, and whether this is in essence asking BP to stop all investment in oil and gas. Nick, do you want to have a first go at responding to that one? And Bo, perhaps we can pull the slide deck down now while we have our Q&A.
Yeah, thank you. So I suppose the first thing to say is that this is a disclosure-based resolution. So all of the asks within the resolution are focused around sort of improving BP's disclosure and improving transparency around BP's capital allocation process, essentially. So this doesn't have any bearing in terms of sort of what the actual capex will be as it relates to this. But really where we're coming from is that there is this increasing capex that BP's announced for the upstream, and there is this chronic underperformance from BP over the past sort of 15 years or so. And so what we want to sort of bring into the discussion here is sort of a greater degree of accountability. And it seems that BP is wanting to go in the opposite direction. They spoke about in their notice of meeting that there's this mandate for less disclosure from the company. We don't fully understand where that's coming from, but we think that the company that has performed so poorly and that is sort of putting its sort of neck above the parapet, I suppose, in terms of really betting big on oil and gas now after moving away from its investments in clean energy, that should come with some safeguards for investors in terms of capital discipline. And then I suppose the thing that we find really difficult to square is how BP can talk so I guess enthusiastically about taking a disciplined approach to capital expenditure while increasing this capex. And this is based off of the same portfolio year to year. And so we sort of struggle to see how those two things can be true at the same time. So yeah, this is really focused around disclosure and accountability and making sure that there are safeguards around that capex budget that BP's announced.
Katerina, I wanted to just give you the opportunity to share any particular perspectives on that question.
Yeah, I mean, not much to add to what Nick has already said. I think that criticism was levelled against prior resolutions not filed by ACCR, but in particular, I think, the Follow This resolution at Shell a couple of years ago. And I would just say that, again, this resolution is a different resolution in its nature. That Follow This resolution was to set targets, which is more directive of company strategy. I mean, we didn't agree that it would have led to, at the time, I think the concern from Shell was that they said that we would need to sell all of our upstream and we'd be forcing them to break up the company. But to level this criticism against this particular resolution, which is disclosure focused, I think is not a very strong argument.
Yeah, thank you. And I wonder if, while you have the floor, Katerina, you wanted to speak sort of from your perspective as a long-term institutional investor in BP around this, well, I suppose, firstly, this mandate for minimizing disclosure and the other sort of governance concerns, shareholder rights concerns raised by the notice of meeting, moving to virtual and the AGM is rescinding with 2 other proposals, excluding follow this. How is that kind of landing for you?
Yeah, I think when we saw the notice of meeting, actually probably the response to this particular resolution was the least surprising of events as we were reading through it. I think there are concerns about development and governance for the reasons that you've mentioned earlier on. I think particularly, I mean, there is the opportunity to vote on the virtual AGMs, and there is the opportunity to vote on revoking the 2 prior shareholder resolutions. So I think there is a really big concern about the follow this resolution not being put to a vote, because whether you agree or disagree with the asks of the resolution, it is important for shareholders to be able to vote on it. And I think it's not completely unprecedented in the UK, but it's not been done very frequently before, and I think it could set a bit of a negative example and sort of suggest we're moving a little bit into more of a US environment, more litigious as well, because obviously follow this have threatened legal action. And to be perfectly honest, I'm surprised that the company is wanting to go down that route, having had many shareholder resolutions on the ballot in the past. I think there has also been a bit of a concern for us in terms of access to the company. So we are able to get meetings, but we haven't been able to engage with the new chair when we have had the opportunity to do so with the previous chair. And definitely the potential move to virtual only AGMs, again, it's obviously being put to a shareholder vote, will remove a really important mechanism for shareholders to engage with the company, particularly when it's been challenging to get a meeting with the chair. So I think in combination there are many things going on at this AGM, and I think will be a really important one in this year's voting season. I think just on the asks of this resolution, we filed it obviously before we knew of all of these changes. I think we'd take it slightly separately and look at the resolutions asks and whether they have merit irrespective of what's going on. And I think they do, because again, we have concerns about this strategic pivot, and we just want to make sure that there is enough disclosure for investors to feel like they really understand and can challenge the company on those decisions. But I would also say, I think with a lot of these moves that seem to have the objective to reduce transparency and reduce scrutiny of the decisions, it's probably more important than it was 2 months ago for this particular resolution and the asks of the resolution.
Yeah, thank you so much for that, Katerina. And yeah, I mean, I think on a related note, one of the questions that we've been getting a lot from investors this proxy season in relation to this resolution, and particularly topical given that she starts tomorrow, has been about the incoming CEO, Meg O'Neill. And we as ACCR have worked for many years on Woodside, and we're often sort of asked our perspectives on her and how we see this resolution as being kind of appropriate in light of this new incoming leader at the company. So I wondered if you had thoughts on that. I'll also turn to you. Maybe Nick, you want to start, and then Katerina, if you have thoughts on that as well.
Yeah, I suppose what we've seen in terms of how Meg O'Neill sort of led the ship at Woodside is that we saw Woodside go through a massive period of growth during her tenure, increasing production by around 5 times under her leadership. We also saw a resistance, I suppose, to responding to minority shareholders. So famously, or maybe infamously, Woodside received the only majority vote against its transition plan, climate transition, vote on the transition plan. And the response from the company was very muted. What we hear from a sort of reputational perspective is that she's very focused on execution, very good at execution. And so when she has a mindset on what she wants to do, then she sort of does it very well. And that was sort of the mandate that she got focused on at Woodside. So we started this work with BP sort of 18 months ago or so, and really started ramping up in Q3, Q4 last year before her announcement in December. But sort of we really think this becomes much more important now, sort of this being the most impactful time, I suppose, to influence the thinking of the new leadership team of Meg O'Neill and of Albert Manifold, who came in September 2025 as well. So it's a little bit coincidental, but I think raises the importance of this resolution at the AGM this year.
Thank you. We've probably only got time for one more question, and so let me just put that to both of you for sort of any final thoughts. And it's a little bit linked to the sort of opening question we had around the sort of focus of the resolution, and it's a question about sort of current narratives that we're hearing in the oil and gas sector around a looming production gap, around falling reserve replacement rates. And the question is sort of, how do you think about this resolution? Is it appropriate to be shining a light on exploration and the shareholder value from that in light of these prevailing narratives? So maybe just sort of 30 seconds from each of you on that as a closing thought.
Yeah, happy to. I mean, as I said, I think this becomes more timely as a result of everything that's going on and the uncertainty around longer term demand. I think what this opens up is a sort of really important discussion around value for shareholders. And what we're worried about right now is that there's this increasing focus on volume and the sort of less scrutiny, I suppose, from shareholders around what the return on investment associated with that is going to be. And so it's a sort of worrying sign that we see this preference by oil and gas companies to reduce buybacks. BP famously cut their buyback at last year's earnings call, but we saw similar moves by Total and Equinor in terms of reducing their buyback this year. We may see a reversion of that based off of the sort of current oil price environment, but in favor of sort of longer term production growth and with this view around demand being higher in the sort of medium to long term. We don't think that that's supported by the fundamentals. We looked at the IEA's current policy scenario, which is the most conservative of the IEA scenario, and which we don't think is realistic because it doesn't include any evolution in climate and energy policy. But between 2019 and 2025, we see a reduction in both demand for oil and for gas within that very conservative scenario. And so we don't think that the bullishness in the industry right now is supported by the fundamentals as it related to clean energy technologies and oil and gas demand as well.
Yeah, thank you very much. I've seen a question come through on the chat from Raj. I don't know that I'll have time to cover that now, unfortunately, but we can follow up directly by email, and we can also include a few notes in our email that will go out probably tomorrow that will share the recording of this webinar. So with that, I will thank both of our speakers and all of you for joining us for this webinar. And yeah, as I said, we'll be sending follow-up materials and are available for individual briefings or any kind of follow-up questions you have as you finalise your votes for the AGM on the 23rd of April. Thank you all very much.